Good morning everyone, my name is Shanas. Okay, so for our group presentation, basically we'll cover four subtopics. The first one is regarding the type of business such as a profession, a vocation. And then the second subtopic is we discuss about the badges of trade, which is basically regarding the characteristic of a business activity. And then the third subtopic is illegal trading, illegal activities such as gambling. And then the last topic that we'll cover is capital receipt, revenue receipt, capital expenditure, and revenue expenditure. Okay, so what is the definition of business according to Income Tax Act? So according to the Section 2 of Income Tax Act, a business is any profession, vocation, trade, manufacturing, or any other activities that has the same characteristic of a trading activity. And all the income earned from all these businesses, they are treated differently compared to the income earned from employment because they have their own Income Tax Act. Okay, so to understand more whether a job is considered as a profession, the income earned, is it from a business or from an employment, we'll take a look at all these different type of sources. Okay, so the first one is profession. What is a profession? Profession is basically a job that requires a specialized skill in a certain area. It usually requires a lot of intense training, a lot of qualification, certification. You can think of a profession like a specialist. Okay. How do we consider a job as a profession? We'll take a look at these three cases, which is CIR versus Maxse, Alicat Sdn Bhd versus DGIR, and the Sdn Bhd versus DGIR. So let's take a look at the first case, which is CIR versus Maxse. Okay. In this case, Maxse is a sole proprietor, meaning he's a businessman. At the same time, he is also the editor, the contributor, and the owner of a monthly magazine. Okay, so what happened here is before the war broke out, he hired 3 workers to manage for managing, advertising, and selling his magazine. And at the same time, he also contributing a certain part of the magazine by himself. So what happened here is he has to pay the manager, he has to pay all the club, he has to pay the other contributor as well. But after the war broke out, he didn't hire any workers at all, and he also didn't pay other contributors, and all of the content of the magazine are managed by himself. So what happened here is the issue here right now is whether the income earned from selling the magazine is taxable as business income, because based on the argument from the CIR, selling the magazine is aligned with the normal cost of the business of Maxse, because Maxse is also a businessman, sole proprietor, so it should be taxable as a business income. So the final decision is the court held that Maxse, he's doing 2 jobs at the same time, meaning that he's a businessman at the same time and also a journalist. So what they need to do is the income earned from selling the magazine should be taxable, but at the same time he himself as a journalist, he should get any allowance as well. So meaning that the income earned is taxable, but at the same time the company, the Maxse company himself, they also get some allowable expenses as well. They can deduct all these expenses. Okay, so this is the final decision for CIR versus Maxse. Okay, next, the second case is Alicat Sdn Bhd versus DGIR. So for this case, it's a little bit different. It only concerned about whether a worker is an employee or not. Okay, so what happened here is Alicat, he's a company that sells stainless steel houseware, the pan, the utensils, and then he also sells water filter to the public through individual, meaning that he does not has any permanent employee. So what happened here is Alicat Sdn Bhd says in the agreement for all the individuals that help the company sell all these products, they will get a free overseas trip, and of course including all the airfares, all the tickets, and the accommodation if they reach a certain sales quota. So what happened here is he deduct all these expenses the Alicat Sdn Bhd treated all these expenses as benefit in kind, meaning they are deductible under Income Tax Act. So the DGIR say that they are not deductible because according to the section 39 of the Income Tax Act, entertainment, this is considered as an entertainment expenses. Entertainment expenses, they are only deductible if they are incurred, I mean they are used if the company want to promote other things. For example, if the company provides some entertainment expenses for the worker just to entertain other potential client to get more income in the future, then it is allowable. But in this case, it's only an incentive, meaning that even if the company didn't give any flight ticket, they didn't give all these free overseas trip, the company won't get any future benefit as well. So it is considered as an incentive, and they are not entertainment for any potential client, so they are not deductible. But according to the Alicat Sdn Bhd, they say that it should be deductible because the company considered all these individuals as the workers of the company, and they should be deductible as a benefit in kind. So the final decision from the court is the DGIR, they are correct, and it should not be deductible under Income Tax Act because they are only an incentive. Because why? Because there is no master or servant relationship between the individual and the company, because they are paid by commission, through commission, and there's no any agreement that stated this individual is a company and is there any monthly income they can earn. There's nothing like that. So basically they are individuals, whether they want to work or not, it's up to them and not to the company. So again, the appeal from the Alicat Sdn Bhd, they were dismissed. So it is not, the expenses is not deductible under Income Tax Act. Okay, so for the third case, which is Sdn Bhd versus DGIR, this case is quite similar to the previous cases, Alicat Sdn Bhd. So in this case, Dr. Y, he's a foreigner. He was appointed as a governing director for the Sdn Bhd. So what happened here is every biannual year, we call him Dr. Y lah. The Dr. Y, he will receive a free overseas trip from Malaysia to the UK, and at the same time, he is also receive monthly remuneration and also a share of profit from the business as well. So what happened here is it the income earned by Dr. Y, the remuneration, the overseas trip, or the share of profit, is it deductible according to Income Tax Act? So the argument from the DGIR is, since Dr. Y, he is not an employee because he's a he's a some sort like a contractual person, a contract person. So he is not the employee of the company, and the income earned, the remuneration earned should not be deductible. So the Sdn Bhd, they argue that Dr. Y, even though in nature he is not the employee of the company, but based on the characteristic of the contract, like for example, they sign a contractual agreement, meaning that he will receive monthly remuneration, the share of profit on a regular basis, meaning Dr. Y, he need to provide service for a period, not only one time. So it match some of the characteristics of a trading activity. So it should be considered as what they call a business lah, and automatically Dr. Y, he should be considered as a employee of the company, even though there is no master-servant relationship. They only based on the characteristic of the contract itself, the nature of the contract, and they consider Dr. Y as the employee of the company. Okay, so the final decision from the court is the Sdn Bhd, they are correct, even though they only sign a contract and there's no any some sort like employment agreement between Dr. Y and the Sdn Bhd, they still consider Dr. Y as an employee of the company, because the Sdn Bhd, they also mentioned that they want to make Dr. Y their employee, but the regulation in Malaysia didn't allow didn't allow foreigner to be the governing director of a company. So they can only sign through a contract and pay on a regular basis. So this is the final decision. The remuneration, the share of profit, and all these cost of overseas trip, they are deductible because they consider Dr. Y as the employee of the company. Okay, next, the second source of, the second type of business is vocation. Okay, so what is a vocation? Vocation is basically a job where people, how to say, a job where people are motivated to do it. Basically, it's like a hobby, but at the same time, they are earning income as well. Usually, an example of vocation is like a charity job where people, they will get motivation. You know, some people they like to help other people, or any other hobby like gambling, even though it's illegal, but sometimes it is considered as a vocation as well. So to understand more about what is a vocation, we will take a look at these two cases, which is the Billam versus Griffith, and Partridge versus Mallandaine. Partridge versus Mallandaine. Let's take a look at this first case, Partridge versus Mallandaine. Okay, so what happened here is Partridge is what we call a bookmaker. Basically, what he do is a bookmaker. His job is to take bet from the customer and pay out all the odds for the betting. You can think of him as an agent of gambling. He will receive the betting money from the customer, and if the customer won the lottery, he will pay out. They will pay the amount to the customer. So what happened here is, even though this is not his original occupation, but he did this job, bookmaker, systematically. It means there's a system. He do it every year. How he's going to do it, how many times he's going to work as a bookmaker, and he will earn some income from it. So what happened here is it the income earned from this bookmaker, is it taxable under Income Tax Act? Okay, so according to Partridge himself, he said that he didn't keep any account for this, and every year all the account information, all the transaction, everything information will be disposed at the end of every year. So Partridge only think of this job as a hobby, and it is not a vocation. So any extra income earned from being a bookmaker is not taxable under Income Tax Act. But according to the DGIR, they say that the income should be taxable. Why? Because Partridge carry out this job, this vocation, this bookmaker systematically, meaning that he's carrying out this job more than a single period, and there's a regular basis on it. So you can consider it like a side job, a side income. So the court held that the income earned from this activity should be taxable, even though it is some sort of not legal activities, but it is still taxable under Income Tax Act, because one of the characteristics, which is I think is a frequency of the transaction, is one of the characteristics of the trading activities. So automatically it is considered as a business. Okay, next, the second case is regarding the Billam versus Griffith. Okay, in this case, Billam, he's a barrister, meaning a higher level of lawyer. He was appointed as a secretary for a national organization, and at the same time, he was trying to produce some place, and he want to sell it to earn some profit. And after a certain period, he successfully sold his place, and he obtained a lump sum of royalties from the producer. So what happened here is whether these royalties, a lump sum of royalties, is it taxable under Income Tax Act? So based on the argument, the Billam's argument, the royalty should not be taxable under Income Tax Act, because Billam, first of all, the moment he received this royalty, he is still working as a secretary, meaning that writing play is not his main job. And then the second thing is, this is a single transaction, because the producer only pay one time in true lump sum. They only pay one time, so this is only a single transaction, and it is not it is not a business that keep occurring continuously. So this is Billam's argument. But from the perspective of DGIR, they say that even though it's a single transaction, but the nature of the transaction, which is royalty being paid lump sum, can be considered as a annual profit, because lump sum can be considered like maybe the producer pay 5 years worth of royalty to the to Billams, as long as the movie are being played or distributed to the other country. So the nature itself is considered as an annual profit, which is a transaction that keeps occurring continuously. So the final decision is the court judged that the royalty received is taxable under Income Tax Act, even though he only received one time the transaction and working as a secretary at the moment. So even though he is not his main job, but the nature of the activities meets the characteristic of a trading activity, so it should be taxable as a business income under Income Tax Act. Okay, then next, trading activities, they are considered as a business as well. Trading activities is basically where all the voluntary parties, they will try to do a transaction of selling and buying all the commodities at arm's length, so this is trading. Trading, they are considered as business as well. And then the second one is manufacturing. Manufacturing means like production of large scale of products. Usually they involve conversion of raw material to a finished product. So this is manufacturing. The income earned from manufacturing and trading, they are also treated. They are chargeable under Income Tax Act as business income. Okay, next, adventure or concern in the nature of trade. Okay, so what is the meaning of this? It means that any isolated transaction or any transaction that does not occur in the normal course of business can be considered as a business if it meets the character. It has the same characteristic of a trading activity, and if it has the same characteristic of a trading activity, it should be considered as a business and should be treated as a business income under Income Tax Act. Okay, so let's take a look at these two examples: DEF versus the Comptroller of Inland Revenue, and Mrs. Properties Sdn Bhd versus DGIR. Okay, so for the first case, DEF, he's a person. So basically, he working as a manager at a company that do not deal with property or land at all, meaning that his job does not deal with any investment or trading activity of a property or land. Okay, so what happened is he obtained an information from his neighbor regarding a rubber estate in Ipoh for sales, and he want to purchase it and resell it for profit. So he purchased it by borrowing loan from his own brother, meaning that he's not using the company's money, he's using his own money. So he bought the rubber estate and then he resell it for a company. So what happened here is the income earned from selling that land from the estate, is it chargeable as a business income? So the argument from the DF himself, the appellant himself, is that he said this is a capital gain, this is not a revenue gain. Why? Because this is an isolated transaction where he do not involve in the company, he did not use the company money, and at the same time this transaction only occurs one time. So this is not a trading activity, and it should be considered, the profit earned should be considered as a revenue, as a capital gain instead of revenue gain. So it is not a business activity, it is not a business. So the final decision from the court is the appellant is correct, and all these transactions, the characteristic of transactions do not meet the characteristic of a trading activities, meaning that it is not a business. So the income earned should not be taxable under Income Tax Act. Okay, next, the second case is Mr. Properties Sdn Bhd versus DGIR. Okay, so what happened here is Mr. Property Sdn Bhd is a property development company, and they bought a piece of land in, I think, around 1992, and they disposed a certain part of the land, and the income earned, they will assess under RPGT, Real Property Gain Tax. Okay, so the problem right now is the DGIR, they say that the income earned from selling that piece of land should be reassessed as under Income Tax Act instead of RPGT, because the DGIR say that Mr. Properties Sdn Bhd is a property development company, meaning that buying and selling a land is a trading activity, and it is a normal course of business, and it should be treated as a business income as well. So the argument from the what we call the Mr. Properties Sdn Bhd is that they say they bought the land for investment purpose, not for trading, not for resale. They only sell a certain piece of land because they found that they how to say they need emergency money. So what happened here is whether the income earned, is it from how to say, is it a capital gain or is it a revenue gain? So the court held that the income earned from selling that piece of land is a revenue gain, meaning that it is a business income and should be chargeable to tax. So the argument is, first of all, the Mr. Property, they fail to prove that they bought the land for investment purpose. Instead, they really bought the land for trading purpose. They want to buy it and then sell it to earn the profit. And then the second point is they are conducting a property development activities. The company are managing all these property development. So it is a normal cost. How to say? Is it a normal? It's a normal activity for them to buy and sell land to earn some profit. So this is a final decision. The income earned from selling the piece of land should be assessed under Income Tax Act instead of RPGT. So this is a final decision, even though the Mr. Properties Sdn Bhd, they argue that first of all, they bought it for investment purpose, but it has been refuted by the DGIR. The second point is, they say that all this profit, they are already been concluded and assessed under RPGT. So the DGIR, they do not have the authority to reassess previous year assessment again. So again, according to Income Tax Act, the DGIR, they have the authority to reassess previous year income tax assessment. So the appeal from the Mr. Properties Sdn Bhd, they were dismissed. So that's all. That's all from me regarding what is a business, a type of business. For the next part about the badges of trade, which is regarding the characteristic of the trading, I will pass it to the next presenter. Okay, thank you so much.
Hello everyone, my name is Julian, matrix number 270761. I will present about the badges of trade. In practice, the principles laid down by the court in precedent tax cases, collectively known as badges of trade, are used as a guide in determining whether a person is carrying on trading activities or otherwise. In 1955, a report by the Royal Commission on the Taxation of Profit and Income reviewed the cash law and identified 6 badges of trade, which are profit-seeking motivated, period of ownership, method of finance, development or processing of assets, nature of the subject matter, and circumstances leading to litigation. The first of badges of trade is profit-seeking motivated. It is clear that having an intention to make a profit can indicate a trading activity. However, by itself, it is not enough. If an asset is acquired with an intention to make a quick profit at the outset, it could indicate that trading activity exists. Rutledge versus LLC is the foreign case under profit-seeking motivated. This case concerns about whether the profit of the tax payable was liable for assessment to income tax. Fact of the case. In this case, the tax payable was a money lender who was also interested in a movie theater business in 1920. He was offered the opportunity to buy a large quantity of toilet paper with a total of 1 million rolls of toilet papers for a very cheap price, which is only £1,000, and he managed to sell the entry consignment to one person at higher price, which amounted to £10,000. Argument for or against. The commissioners stated that the profit he gained from reselling the toilet paper are taxable. However, the tax payable claimed that it was an isolated transaction. Judgment and return. Since the tax payable bought the toilet paper in a large quantity and it is not part of his normal business, therefore, the court held that the profit to be tax payable as a purchase was made for which intention for resale as profit and the deal was in the nature of trade. The second period of trade is period of ownership. Generally, an item purchased as an investment is often held for a long period of time, within an item purchased for trade will be disposed of within a relatively short term in order to make profit. Hence, the longer the period of ownership of an item before its disposal, the stronger is the argument that the item is not purchased for trading purposes but for investment. ALF Properties Sdn Bhd versus Ketua Pengarah Hasil Dalam Negeri is the Malaysia case under period of ownership. In this case, the issue was whether the land purchased by the appellant ALF Properties Sdn Bhd is an adventure of the nature of trade. Fact of the case. The appellant was incorporated with the primary objective of carrying on the business of property development and construction. The appellant purchased 7 lots of land at a public auction in 1980. The purchase of the land was stated as bidding for the development of an office complex for rental purposes. However, the appellant sold a part of the land in 1990 as it was not necessary for the construction. The respondent subsequently assessed the appellant to income tax pursuant to Section 4A of the Income Tax Act 1967 on the basis that it had traded in land. SCIT rejected the appellant's appeal for the income tax as the land was held for the investment purpose or the gains obtained from the sale of the land constituted the realization of an investment. Argument for or against. However, the appellant contended land that has been classified as development property and had evidence of valuation report that indicated the employed to sell the land. The land was maintained for 10 years from the date it was purchased and showed that it was intended for investment purposes. Judgment and return. Therefore, it was held that the land is not considered an adventure of the nature of trade and exempt from tax. The third Measure of trade is method of finance. Determining the source of finance is important when deciding whether a trade is carried on. Finance taken out to purchase an asset in the first instance may indicate the to repay the debt the asset will have to be sold. Lim Foo Yoong versus Comptroller of IR is the major case under method of finance. In this case, the issue was whether the surplus is the result of the respondent business activity or it is only the relation of the investment. Fact of the case. The respondent purchased 5 pieces of land at Colombo and built a hotel on the site at the cost of 2,377,490 ringgit, of where 2 million was borrowed from the EPF board to which the hotel and its land were charged. The respondent made an agreement with the EPF board to sell the hotel and its land to the board for 5 million ringgit. The difference between the cost of the building and sale price gives a surplus of 2,622,510 ringgit. The respondent sold to the hotel company the land and his right to repurchase the property. The sale of the repurchase right was at a consideration of 4,201,000 ringgit. Those considerations are considered to be taxable. Argument for or against. According to Special Commissioner, the mere fact that the property value exceeded the cost of acquisition automatically qualified the asset as a taxable profit from trading. Judgment and return. The asset was a taxable profit from trading. According to Special Commissioners, the mere fact that the property value exceeded the cost of acquisition. Next, the measure of trade is development or possessing of asset. If material alteration of improvements has been made to the asset equivalent or that its character of quality has been changed to make it more readily marketable, it will tend to indicate a profit-making undertaking. However, if an asset was clearly created for other purposes and subsequent improvement was done to render it more sellable after it was no longer useful for such original purpose, it shall not cause the gain to be taxable. Brandy Syndicate versus IoT is the foreign case under development or possessing asset. The issue is whether the profit from registered ones is taxable. Fact of the case. In this case, 3 individuals formed a syndicate and possessed a quantity of brandy. This was shipped to England and blended with some French brandy, registered and sold to various buyers. The enterprise was sold over a period of 18 months. The syndicate was not involved in any other transaction. Argument for or against. The syndicate agreed that it was an isolated transaction and Therefore, the profit should not be taxed. Judgment and return. The judge held that the profit was taxable arising from an adventure in the nature of trade. Then, the nature of trade is nature of the subject matter. The manner an asset was acquired is an indicator of whether it was acquired for itself or that it was acquired for private use or as an investment. If it is inherited or gifted, it is a good indication that the asset was not acquired with a view to sell for profit. Cooke versus Haddock is the foreign case under nature of the subject matter. This case concerns about a solicitor who bought a land which are suitable for development. Fact of the case. He did not take any step to develop the land or advantage it for sale while owning it. However, between 1949 and 1953, he was appointed by individual and he decided to sell 23 building blocks. In 1954, he sold a further 19 and a half acres to a building company with an option for the sale of a further 23 and a half acres within 7 years. Argument for or against. His income was terrible, but the tax payable claimed that it is an isolated transaction and the land has been purchased as a long-term investment. Therefore, he claimed that it was not taxable. Judgment and return. However, in this case, it was held that the income is taxable due to the purchase and sales constituted the carrying on of a trade. The special commissioners held that the sales were made in the course of carrying on a trade or adventure in the nature of trade. The last one of measure of trade is circumstance leading to liquidation. If the sale is occasioned by an unanticipated need for funds or following an unsolicited offer, such fact will tend to indicate that the sale is not made pursuant to a profit-making scheme. If the sale is part of a sale scheme for a quick profit, it may apply towards a training transaction. Penang Realty Sdn Bhd versus Ketua Pengarah Hasil Dalam Negeri is the mentioned case under circumstance linked to liquidation. In this case, the issue was whether the compensation received by the appellant as a result of compulsory acquisition of a portion of their land is taxable under Section 4 of the Income Tax Act 1967. Fact of the case. The appellant bought 2 pieces of land. The evidence showed that a portion of the subject land, Lot 2833, Bandar Tanjung Bongat, was compulsorily acquired by the government in August 1980. In May 1982, the appellant was paid the sum of money as compensation where ILB sold to tax the said compensation and accordingly assessment that sum. The appellant was unhappy with the assessment imposed and appealed the Special Commissioners of Income Tax and it was dismissed. Argument for or against. The appellant claims that the property was forced to be sold to the developer because the appellant members did not take out the loans that were supposed to be sold to them. The appellant had no choice but to sell to the developer in view of the predicament in which it found itself and the inability of the appellant to raise funds from banks or financial institutions to finance its housing project of which the beneficiary was its member. Judgment and return. The Court of Appeal held that it was not subject to income tax, ruling that the government's compulsory acquisition of the employment lands could not be considered as sale with taxable processing because the element of compulsion predicted the intention to trade. That's all for my presentation. Thank you very much.
Good morning, Doctor and everyone. My name is Teorenza and my normal metric is 277653. Now I'll present about illegal trading. Okay, in this section, in section 4A, there is no any distinguish between legal and illegal for business income. If it is conduct characteristic of business income, it is can be taxable. For the expenses, there is considered as deductible. Okay, now we see for the related case. It is Mann versus Nash. Okay, for this case, it is a tax payable work in the environment industry that is running out the automatic gambling machine for public use. For the profit for selling the public automatic gambling machine, it is the source of his income. There were also illegal gambling machine among the ones offered, so there is legal and illegal gambling machine in this case. The tax imposed on the revenue generated by both legal and illegal machine. However, the taxable said that the revenue from illegal trading would not taxable. So do you think that illegal trading is not taxable? So we look for the judgment. Even though the proceed for this transaction come from illegal trading, but the income tax had to be paid on them. So this is for illegal trading, it is taxable in this case. So now we look for the case 2, it is Haws versus Nash. In this case, the profit was not taxable. So we look for the facts first. A third commission agent had his earning from marketing to huge speed tax for good cost tax. So even though the contests were widely promoted and the state did nothing to stop them, they were nevertheless illegal under the statute in effect at that time. So in this case, the High Court of Ireland ruling was overturned by the Supreme Court of Ireland that the profit was not taxable. The revenue is not permitted to tax earning from activity that the state has deemed to illegal unless specific permitted. Now we look for the hobbies and gambling. So for the part of hobbies, it can be considered as taxable. So we look for the case Haws versus Gardiner. So a tax payable was asset tax on the earning from his hobbies, breeding and trading of greyhounds, which he then sold as puppies for high price. So this is his hobby. So this is considered as taxable. The selling of such puppies was shown to be problematic given the nature of commerce. So for the part of gambling, if it can be proven that gambling is a form of trade, it might be subject to charge. So we look for the case for Graham versus Green. In this case, the appellant engaged in frequent and extensive horse racing wagering. So wins for largely is the source of his income. So for the judgment or decision in this case, the court wrote that it was impossible to consider a man who lived off of gambling to be the self-employed or to treat his win as taxable income. For the next part, we will look for the speculation. So for the part of speculation can be considered as a tax on profit. It is because commodity speculation also has a sense of gambling and betting, so the speculator may enter into a legally binding agreement. So now we look for the related case. It is Cooke versus Stubbs. So for these cases, the fact is a significant number of transactions. It is 50 transactions annually over an 8-year period. So it is determined to be accessible in this case. So for nowadays, this case is depending on whether the action was considered as speculative rather than the organized as a threat. So it is a question of this fact. The activity may have been viewed as producing trading rather than other revenue. So in this case, in this speculation situation, the assessment would be trading income, so can be taxable. So now we look for the case 2. It is DGIR versus Central Sugar Bhd. So in this case, the business benefit from pioneer status, which at that time was tax-free on profit. So the business also engaged in hedging, which is essentially the selling and purchase of raw sugar in the future. So the sugar refinery and hedging are considered to be one business source according to the High Court. So this is due to the fact that hedging on the terminal market is the only accepted technique of stabilizing the price of necessary sugar in addition to the purchase of raw sugar. Hedging in thus adjuncts auxiliary to an very advantageous adjunct to the sugar refinery industry. In this case, hedging does not turn into a distinct company. Now we will look for the further part. It is mature trading. For the mature trading, it is had a principle. It is mutuality principle. It is stated a man cannot conduct business with himself and the profit from the deal. So it is two concepts. The first concept is a person cannot trade with himself. The difference between contribution and expenses cannot be income in this mature trading. So we look for the related case. It is municipal mature insurance versus Hills. In this case, a corporation limited by a guarantee that was established to allow local governments to purchase insurance against risks including fire and employer liability. Over the year, the company extended coverage to all forms of insurance except marine and life. The company claimed not to distinguish between members of the company and policy holders, but the supplies on both fire and other business were applied as a reduction of the fire premiums. So the revenue considered that the surplus from fire business arise from mature trading. So this business acknowledge that income generated from transaction with people who were neither member of the firm nor owner of the fire insurance were taxable. So for the judgment, municipal merchant insurance did not have such as identified, hence the profit from the other business was taxed. If the firm does not have the business, there will not be any source of trading revenue and nothing to tax.
Assalamualaikum and hi, my name is Muhammad Fahmi bin Ma'inus and my metric number is 280331. So now we move on to the gross income. So under section 32 of Income Tax Act, the subsection 1 says that according to the Income Tax Act, a person's gross income is a source of his for the basis period for a year gross income that having the provision of the Income Tax Act. The subsection 2 said that the gross income should include any sum receivable from the period such as insurance, indemnity, recoupment, recovery, reimbursement, and any compensation for loss of income from that source. So next, the section 24 of Income Tax Act. In those period of assessment, this element of also included in the gross income, which is debt arising from the sales of stock, debt arising from provision of service, debt arising from the use of property in relation to business, drawings, dividend income of share dealing business, interest income from interest dealing business, and also market value of exported goods. Also, for the section 30 of Income Tax Act, during the relevant period of assessment, relevant sum of refunded to the person need to be treated in the gross income. Also, such as bad debt recovered, refund of payroll tax, and also release of debt. So, based on a case, Ketua Pengarah Hasil Dalam Negeri versus Mercedes-Benz Malaysia Sdn Bhd, the issue was whether the cars sold in the secondary sales channel are stock in trade, withdrawn for the appellant own use as devices under the section 24 of ITA. So the decision of the court said that the taxpayer has two modes of earning profit, which is the manufacturing and the selling vehicle. So the taxpayer business need to be looked as a whole set operation, which is directed toward the producing income. Because of that, the selling vehicle, which is the stock, need to be treated as a income. Because of that, the withdrawal of the stock for his own use need to be treated as under the section 34, which is for drawing. From another case also, which is WWSP versus Ketua Pengarah Hasil Dalam Negeri, the issue was whether the unpaid value of service provided value need to be reported under section 34 of ITA. So from the case, the fact that the taxpayer has performed a service of RM 4,992,420.66 cents, but only reported the amount they have been paid, which is RM 3,244,899 ringgit and 40 cents. The decision said that the taxpayer failed to defend the facts from KPHD about the total value and the appeal was not accepted. This is because the debt from a service that have been provided need to be reported wholly, not only the paid one. Now we come to the capital receipt and the revenue receipt. So capital receipt means that sum received from the transaction out of business scope, such as fixed asset, and revenue receipt is a sum received from a firm activity throughout the financial year. So the category has been set to define whether it's a capital receipt or revenue receipt, which is nature of the recurring, impact on profit, and short term or long term of the receipt. So from a case of Holdings Sdn Bhd versus the Ketua Pengarah Hasil Dalam Negeri, the fact says that the taxpayer was incorporated as a joint venture company in 1984. Its principal activity was that of property development. In May 1989, real property was injected into the company at a cost of RM 35 million and appeared as a fixed asset in the annual account. So it seems that the Taxpayer Act and conduct also showed the intention to treat the subject property as a trading stock rather than as a fixed asset. Due to the nature of the company, the land is a revenue receipt when it's sold, not a capital receipt because it's not a fixed asset. And now we have the sale of non-how. This non-house sale is a sum received from sale of secret knowledge such as patent. The sales can either be capital receipt or revenue receipt. For example, the case of Akamai Technology Malaysia Sdn Bhd NNR versus the Ketua Pengarah Hasil Dalam Negeri, the fact says that the taxpayer are providing internet content service and the taxpayer has entered service reseller agreement with a company in Malaysia. The payment from this agreement are not being reported in the assessment as they claim it not a revenue receipt. The account said that the service reseller payment paid under the service reseller agreement are not subject to withdrawing tax under Section 109 of the ITA, as such payment are not royalty within the meaning of Article 12 of Malaysia and Switzerland DTA. So because of that, the receipt from those agreement are treated as a capital receipt. So another case, which is Director General of Inland Revenue versus Faltan Sugar World Ltd. The fact says that the taxpayer has incorporated in India and was engaged in the growing of sugarcane and manufacturing of sugar in India. It then entered into a 3 agreement with the Negeri Sembilan Development Corporation for the purpose of setting up a joint venture of a non-how agreement. The account said that the non-how agreement constitutes income in respect of royalty under the Income Tax Act, and on the fact of the category, it's not exempted under the Double Taxation Relief of India Order 1976. So it needs to be taxed under the Malaysia Indian as a revenue receipt. So there are also other some receipts that need to be treated in the capital or revenue receipt, such as the payment from the sale of fixed asset, which is some receipt from transaction out of the business scope on the fixed asset. So it needs to be treated as a capital receipt. Other than that, there are also payment for the deduction of asset, which is a capital receipt. The definition of this is a sum received from the transaction out of the business scope on the fixed asset, such as any damage or injury to asset, loss destruction of the depreciation of asset, depreciation or risk of depreciation of the asset. There's still another 3 or other sum received. So the third one is a payment in lieu of trading, which is revenue receipt. The description is a payment that required to be paid using stock but receive the cash instead. Next, we had a payment in return of the imposition of succession restriction, which is need to be treated as a capital receipt. This is the payment due to the process asset during the production, and the last one is a payment that is recurring that need to be treated as a revenue receipt. The payment recurring means that the receipt are from a scheduled payment that need to be paid by the customer. Now we're going to take a look into the capital expenditure versus the revenue expenditure. So for the capital expenditure, there was a case under Mengawarti Sdn Bhd versus Ketua Pengarah Hasil Dalam Negeri. The appellant is a housing development company. They obtained a leasable land from a state government for housing development and paid RM 858,050 ringgit as the land allocation cost. Later, appellant entered an agreement with Maxse Sdn Bhd to develop the land, where Maxse has to pay appellant of RM 900,000. So the issue is the land allocation cost deductible as a revenue expenditure against the RM 900,000? So the judgment is it is a capital expenditure which is not deductible. So the reason is appellant pay the cost to acquire the land and it is not incurred wholly and exclusively in the production of gross income of RM 900,000, and the costs incurred are not in the period appellant received from the income. So for another case also about this topic is that the Director General of Inland Revenue versus Hap Cheong Timber. So the respondent entered an agreement with Persatuan Peladang Negeri Johor to obtain the exclusive right to extract the timber on a certain for a consideration of RM 1.4 million. So the respondent claimed the deduction of RM 1.4 million against their gross income. So the issue from this case is the RM 1.4 million is a capital expenditure or the revenue expenditure. So Director General of Inland Revenue said that the Section 39 of ITA said the sum payable from the use of the license or permit to extract timber from a forest in Malaysia is a capital expenditure. So this is not allowed for a deduction. The judgment is it is deductible because it is a revenue expenditure. The reason is the respondent is not paying for the usage of permit to extract timber. They are paying just to extract timber, which is their main business, and they also cannot plan tree for the future profit. So because the main business of the company is to extract timber, so it need to be treated as a revenue expenditure.